What's up, guys? Welcome to today's video. Hope you're all having a great week so far. It is Saturday once again. Today's video, you guys can tell from the title, my biggest investment regret. This is my most recent rental property that I picked up in May of this year, right at the peak of the market, which doesn't help at all either. But a little backstory on this property. We bought this as a flip back in March, and I ended up buying it from our LLC as a buy and hold property because the previous owners that we had bought it from, we gave them a 2-month lease back, and they ended up having something happen where they basically asked us to give them a 12-month lease because the property they were going to move into actually fell through. So they really had nowhere to go. And in the back of my mind, I was potentially entertaining the idea of buying this out from our LLC regardless. So when they asked us for a 12-month lease, I agreed to them, and I ended up buying my business partner out of the deal. So that comes into play a little bit here. I'm not making up any excuses, but that did have an impact on it. And not only this video, I don't only want to break down this specific deal, but I also want to break down the metric that I use to find deals and what I use to find deals, specifically cash flowing properties, because there's a bunch of different approaches to finding deals depending on what your end goal is for that specific property. So I hope you guys enjoy the video, and let's get it started. So this investment property, like I said, I bought in May at the peak of the market for $465,000 from me and my business partner's LLC. We ended up profiting. I basically profited from myself, if you look at it that way, about $85,000. We were all in from our renovations and when we purchased the property back in February as a business, $380,000, and I bought it from myself for $465,000, which is about an $85,000 profit. So I ended up rolling in some of those profits into my refinance on the property because I had to refinance out of my LLC into my personal name here. So I bought it for $465,000. That's what me and my business partner agreed as fair market value at the time of the purchase. We both agreed on it. Obviously, we both had to agree on it because we were the sellers of the property and I was the buyer of the property. It's funny how that works. I ended up doing this 2 other times before, actually. So this is the 3rd time I've bought a property from our LLC. Appraised value ended up appraising actually $35,000 more than what I bought it for, just based on the market value. So I bought it for $465,000. The bank went and sent an appraiser out and it appraised for $500,000. So the cool thing with an appraised value is the banks will actually use that as the loan to value ratio if you want to. So basically that $35,000 is instant equity into the property. And that's exactly what I did. I ended up getting a higher loan on the property. Instead of going 25% of $465,000, which would have been like $350,000, I ended up getting a loan of $375,000, which essentially saved me $25,000 out of pocket. So I only had to come to close on this property $90,000 instead of $115,000. And then this $115,000 all-in price is on top of the down payment. I also had to pay for closing costs of the property, and then I also had to pay for a little bit more renovations throughout the process as well. So my all-in is $115,000, and my interest rate, for those of you guys that care, 5.25%, which is my highest rate. The loan, like I said, $375,000 or around $375,000. I kind of rounded up to make it easier. My PITI is principal, insurance, taxes, and interest all included in the bundle. That's basically my mortgage, plus HOA, which is like $50 a month. Ends up making my expenses on this property $2,260. Now that is not including CapEx expenses, which I would include if you guys are running your numbers. Some investors go way overboard on CapEx expenses, and then it just starts not making sense when you run your numbers with like $5,000 of capital expenses every single year, which is a safer way to do it, but it sometimes skews the data too much to where the point where you miss out on good opportunities. So I don't like to do huge CapEx expenses. And what I mean by CapEx expenses is like big one-off expenses, like maybe the roof needs to be repaired in 5 years. So instead of having a lump sum, you would take out $100 a month as your expense over the next 5 years, and that would generally cover your one-off expenses like a new AC unit or a new flooring or new roofing down the road. And then my rent on this property is $2,500. So I'm only making $240 a month on a $115,000 investment. Now this video is piggybacking off one that I did the other day. So you guys, if you guys watched that video, you guys probably just already knew all these numbers that I ran through just now. And the metric that I use to basically evaluate if a deal is a good cash flowing deal is something called cash on cash return. It's the amount of money you're making from cash flow on a property on a yearly basis, and you're dividing that by the overall cash that you have invested in that property, and that's basically gets your opportunity cost on the property. Opportunity cost is what deal is going to make me the most money. If you're presented two properties, one right here, and you can only have enough money to buy one of them, this cash on cash return will help you figure out which one is going to be a better opportunity cost from a cash flow standpoint. That's not taking into consideration other risks. That's not taking into consideration other factors like, is this going to be an appreciation play, stuff like that. This is strictly on cash flow of rental properties. So you divide my $2,880 a year, which is what 240 times 12 is. Divide that by my $115,000 investment. That's 2.5% cash on cash return, which is horrible. I talked about this before, but I usually wouldn't touch anything if it's strictly a cash flowing property. I wouldn't touch anything if it's less than 10% cash on cash return, just because generally the stock market over a long period of time, you always want to have like a benchmark. Like, what are you basing your returns off of? A lot of people will base real estate returns off of the stock market and what you could yield from the stock market if you were to invest $100,000 into that rather than real estate, which is about 9.5% over a long period of time. So generally, if you want to beat out the stock market with real estate, you're going to have to be around 10% cash flow or cash on cash return. Also, there's other factors that go into real estate. If you have a long-term rental, you're not only getting your cash on cash return metric, but you're having your tenants pay down your mortgage every single month. So you're having $400, $500, $600 a month of them paying off your overall loan on the property, where you're not going to touch that. And if your property's rented out for the span of the loan, realistically, you never have to pay your own loan down. If you always have tenants in your property, then if you have a $375,000 loan like this, if my house is rented for the next 30 years, give or take a couple months of vacancy or whatever it may be, or whenever I go to sell the property, I would never have to pay down my own loan. That's the end goal here. And then you also have appreciation on the property as well, which the stock market doesn't have. So there's some other factors, but just to keep it simple, cash on cash return is your cash flow, and you generally want to, or a lot of people base it off the stock market or some other things. I don't know. What do you guys base your investments off of? Now going to finding the deal. Figure out what your all-in price for a property is going to be, your down payment, your closing costs, your repairs. And what I mean by repairs, keep in mind, guys, when you do repairs on a property, just because they may be one-off expenses, they're still going to be in your all-in cash expenses. So if you buy a property and then put in an additional $30,000 of repairs, that's going to skew your data big time on your cash on cash return, because your cash invested is going to be much higher than if you were to buy a turnkey property. So keep that in mind if you are going to do repairs. Some people would do repairs and then refinance the property and get money back out, do a cash out refinance, so then the cash invested is a little bit lower. But if you're getting a loan on the property, I did this with my Airbnb, and then you're putting in $100,000 in repairs, yes, your cash on cash return is going to look awful because you put in an additional lump sum of money at the beginning. The next thing you want to do is figure out the market rent. Like, you have to figure out what your income is going to be on the properties that you are evaluating. And then you want to do figure out your monthly cash flow, subtracting your expenses like your mortgage, CapEx expenses like I talked about, which can be $50, $100, $150 a month, what you may not be spending every single month, but eventually the premise is of a CapEx expense is you're adding up all that. You're basically having like another bank account, that $150 or $50 a month that you're going to put away for a big expense down the road. Landscape, if you have that in your contract. The HOA, which is a big thing that often gets overmissed. Other bills, if you're paying the electricity, whatever it may be. I have a student rental that I pay the electric bill on, so I have to keep that in mind. If you have a property manager, which I have 6 rental properties, 1 Airbnb right now, and I don't have a property manager. I have never had a good experience with property management. I've never had one, but dealing with property managers has never been good. Dealing with hedge funds that buy and hold properties, it's always a pain in the ass. So I always suggest, if you're going into a rental property, even if you live out of state, try managing it on your own. And if it's an absolute pain in the ass and it's not worth saving 8 to 10% of your monthly rent, then get a property manager. But a lot of people start with property managers and then they never realize that they can do it on their own, and they're losing 8-10% of their monthly cash or monthly rent, which could be $150-$250 a month, which is a lot of money over a period of time. On this specific property that I bought, I won't even be able to afford a property manager because of how little the cash flow is. But that's also going into my next point here. The next note, things to consider. Renovations can throw off your cash on cash return. I already talked about, and this is what I want to talk about. It's not always about maximizing cash flow. Figure out what your goal is for the specific property. Is it an appreciation play? Is it going to be a primary residence that you eventually turn into an Airbnb or a rental property? Because those, if you have a different goal than just strictly cash flow, like this specific property, I kind of bought this with the anticipation of this specific area in Arizona really appreciating a lot faster than all the other markets. So I was like, you know what? This is most likely going to appreciate. This is in a really good area, up and coming area. A highly developed area. This will appreciate a lot faster than another investment maybe in Phoenix, Arizona, that's 60 years older of a property. That will be a great cash flowing property, but it won't appreciate as fast. So you have to consider that in as well. Like, what is your goal for the property? If you're strictly buying a property to own it for 3 to 5 years and then sell it down the road with a big appreciation, cash on cash return might not be the metric you want to use because it's a whole different outlook on what you're going to use the property for. So thank you guys so much for watching. I appreciate it. A big thing on why I specifically ended up following through with this property is because the tenants wanted to stay there. Me and my business partner as an LLC, we do not buy and hold properties, at least right now. So it was kind of like, I'm not blaming anyone. I still made the end decision. Yes, I could have told my tenants, no, I'm not extending your lease. You guys have to move out per our agreement. But I ended up just following through with it, and yes, I could have used this $115,000 somewhere else and made quite a bit of more money, but it's also the appreciation of the property as well. So that's it, guys. Thank you guys so much for watching. I appreciate it. Drop a like, drop a comment, follow me on TikTok, follow me on Instagram, and I'll see you guys soon.